current market price for Intel Corporation, ticker symbol INTC, is sitting right at $43.76, trading up roughly 0.64% on the intraday session as we speak. You might see that number and think nothing of it. Just another day for a legacy tech giant, right? That is the expectation. The general consensus, the cocktail party chatter, is that Intel is the safe but boring stock. The one your parents bought in the 90s, the company that got left behind while NVIDIA and AMD sprinted ahead into the artificial intelligence future. The expectation is that this is dead money, a value trap, a company stumbling over its own shoelaces while trying to manufacture chips that others design better. That is what the headlines have been screaming for 3 years. Here is the reality. And it is a reality that should make you sit up straight if you have any capital deployed in the semiconductor space right now. While the world was busy looking at other shiny objects, Intel has quietly staged a stock performance that is defying every bearish thesis on Wall Street. Over the last 6 months, this stock hasn't just recovered. It has effectively doubled, rallying nearly 95% from its lows. If you are looking at your Fidelity mobile app or checking your Schwab Intelligent portfolios, you might be shocked to see that the boring stock you ignored has outperformed some of the hottest names in tech over the last 2 quarters. The reality is that Intel is no longer trading like a blue-chip utility. It is trading with the volatility and aggressive upside momentum of a growth startup. This isn't a story about a slow recovery. It is a story about a violent repricing of a massive asset that the market incorrectly assumed was finished. Let's break down exactly what is happening on the tape today, because the price action is telling us a very specific story. We are seeing Intel holding firm above the $43 level, which is critical. For weeks, traders on platforms like Interactive Brokers and those using the advanced charting on the Robinhood app have been watching to see if Intel could break and hold above 42. It has. The volume we are seeing today is healthy, not panic selling, not manic buying, but steady accumulation. Institutional investors, the big money that moves markets, appear to be stepping in every time the stock dips even 20 cents. When you see a stock refuse to go down on bad news or general market choppiness, that is a sign of underlying strength. The immediate catalyst driving this intraday movement isn't just one thing. It is a convergence of manufacturing optimism and geopolitical necessity. We're seeing reports and whispers, some confirmed, some speculative, about increased efficiency in their foundry business. For the longest time, the bear case on Intel was that they couldn't make chips efficiently anymore. The market expected delays. The reality we are seeing today is that they are hitting targets. When you open your SoFi Invest account or look at your Robinhood fractional shares, you are seeing the result of a market that is suddenly realizing it may have mispriced Intel's manufacturing capability by billions of dollars. Furthermore, we have to talk about the Apple rumor that has been circulating on trading desks. There is chatter, and keep in mind, in the stock market, chatter often moves price before facts do, that Apple might be looking at Intel as a potential manufacturing partner again, not for CPUs, but for other silicon needs as supply chains tighten globally. Whether this solidifies into a contract is almost secondary to what the rumor does to the stock. It forces short sellers to cover. If you are shorting Intel on your Interactive Brokers trading platform, the last thing you want to hear is that the largest company in the world might start writing checks to the company you're betting against. This tension is creating a buy the rumor environment that is keeping the floor under the stock price incredibly high. But to really understand why this matters, we have to strip away the stock ticker and look at the company itself. Most people think they know what Intel does. They think processors for laptops. That's the old Intel. That is the expectation. The reality is that Intel is currently attempting the single largest pivot in the history of the semiconductor industry. They're trying to become the Western Hemisphere's alternative to TSMC. They don't just want to design chips, they want to build everyone else's chips. This is a massive, capital-intensive gamble. It requires tens of billions of dollars in upfront cash. It's risky. It's terrifying for a conservative investor who just wants a dividend. But if it works, it transforms Intel from a product company into a utility provider for the entire digital age. Think about the workflow of a modern investor. You might sit down at a coffee shop, open your laptop, likely powered by an Intel chip, and log into your Fidelity brokerage account. You might place a trade for an ETF that holds NVIDIA. But who is going to build the chips for the next wave of AI if Taiwan becomes geopolitically unstable? That is the question driving Intel's stock price right now. The reality is that the United States government cannot afford for Intel to fail. The CHIPS Act funding is not just free money, it is a strategic mandate. Intel has become a quasi-sovereign asset. The market is waking up to the fact that the downside protection here isn't earnings, it's national security. That is a very different valuation model than simply looking at PE ratios. Speaking of PE ratios, let's address the elephant in the room. If you look at Intel's price-to-earnings ratio on a surface level, it looks broken. It looks astronomically high. This scares away the novice investor who reads a Investing 101 article on a generic investing site and thinks high PE means expensive. That is the expectation. The reality is that the PE is distorted because Intel has been spending heavily on building these new factories, which temporarily crushes their earnings. Smart money, the people managing wealth at Fidelity Wealth Management or using the sophisticated tools on Interactive Brokers, knows to look at price to book, or price to sales, or future free cash flow. They see that the company is trading at a valuation that barely accounts for the physical assets they own, let alone their intellectual property. Let's take a look at the sector momentum. We're seeing a rotation. For the last 2 years, money poured blindly into pure-play AI stocks. Now, we're seeing a catch-up trade. Fund managers are looking at their portfolios and realizing they are overweight expensive software and underweight the hardware manufacturers that aren't named NVIDIA. This is benefiting Intel. When a sector rotates, a rising tide lifts the boats that were stuck in the mud. Intel was stuck deep in the mud. Now that it's moving, the momentum is fierce. You can see this in the options market on Robinhood. The call volume, people betting the stock will go up, has been outpacing put volume significantly in recent weeks. Retail traders are returning to the name not as a boring hold, but as a momentum trade. I want to pause here for a second and get a pulse check from you guys. I'm curious where retail sentiment actually sits on this name right now. Comment below how many shares of Intel you currently hold, or if you sold them all back when the stock was in the 20s. I want to see if the retail army is actually back in this trade, or if this is mostly institution pushing. Now, let's widen the lens to the macroeconomic pressures. We're in an environment where interest rates are a huge topic of conversation. High interest rates usually hurt capital-intensive companies like Intel because they have to borrow money to build factories. The expectation is that rates are high, so Intel should suffer. The reality is that the market is already pricing in rate cuts. The market is forward-looking. It is looking 6 months down the road. If rates come down in 2026, Intel's debt burden becomes much easier to manage, and their profitability explodes upwards. The stock is moving today because investors are buying that future profitability at a discount right now. We also have to discuss the AI PC narrative. Everyone is talking about AI in the cloud, massive server farms, but the next wave is AI on your device. Your laptop running its own AI model so you don't have to upload your private data to the cloud. Intel is betting the farm on this. Their new Core Ultra chips are designed specifically for this. If this shift happens, if businesses decide they want AI on local devices for security reasons, Intel is the only company positioned to capture that volume. It's a volume play, not a niche play. When you look at the competition, specifically AMD, the dynamic has changed. For years, AMD was the underdog eating Intel's lunch. Now, AMD is the expensive incumbent in some ways, and Intel is the scrappy fighter with its back against the wall. Wall Street loves a comeback story. It loves a dog of the Dow that learns new tricks. We're seeing analysts from major firms upgrade their price targets, not because the earnings are amazing today, but because the risk-reward ratio has shifted. If you are a self-investing individual, perhaps using SoFi Active Investing to manage your own risk, you have to ask yourself, am I buying the past or the future? The past of Intel is missed deadlines and overheating chips. The future, if you believe Gelsinger, is 5 nodes in 4 years. That is the technical roadmap.